Here's an email from Rick to kick things off. He's in Edmonton. It's on InvenSense. Could I get your opinion on this company? Remind us what they do.
So InvenSense is a company that makes sensors that go into mobile devices. So we know that mobile devices, like the iWatch, for instance, have all kinds of different sensors in there for temperature and barometric pressure and gyroscopes and so on. InvenSense makes this type of thing. So they really are quite dominant in that space. That's the positive. And there's more and more of that stuff going in. The negative is that about 70% of their revenue comes from Samsung and Apple, which means that they have a lot of exposure to those two. Now, I would say that this is a great business to be in and there's good opportunity there. The problem is that in the fall of last year, InvenSense had some poor execution and they missed their estimates. And I think probably because they have such exposure to Samsung and Apple, there was pressure on their ability to price their product. So I think that for now it's in the penalty box until they prove that that's a short-term issue. But we, as we'll talk today, really like the components that go into mobile devices. So if the price can get turned around and if they can put up a quarter or two of decent numbers, I think this is an interesting company to look for. But right now there are other companies maybe executing a little bit better.
Next up, a call from Yuri, who's in Lang, Ontario. Hi there.
Hi, guys. My favorite companies are Keyera and AltaGas. Any thoughts? I love them both dearly.
Sure. So Yuri, this is a really important question right now, given the kind of environment that we're in. The bull case for companies like Keyera and AltaGas are these are companies with very long visibility on their revenues, right? Keyera has take-or-pay contracts with its customers, and so if you were to look out, you can see what's coming. The downside is they wear the halo of energy. So realistically, while they are much more predictable than a producer or a service company or an equipment company, there is concern in the near term given what's happening with the price of the commodities. Now, I know there's a lot of people who have made a bet that the price of oil has bottomed. I would be careful about making that bet. We have real concern about price of oil and price of natural gas and the volumes that are being produced. So in the near term, we think that there's some risk. These do pay a good dividend, and I don't think that the dividend is at risk in the near term. Most recent numbers came out. They bumped the dividend. They've got a good hedging program. But the longer the weakness in energy goes on, I think the less patience investors may have. So I like the company. I think the theme is not the right theme right now. If you're a long-term investor and can sit through volatility, it's fine. In the near term, it may underperform.
Those who have seen you in the past know that for a long while there, you really liked energy infrastructure. When did your thinking change?
So last summer in July, when the price of oil started to back off, the breadth models we use that look at the percentage of stocks doing well in that universe started to deteriorate. So that meant we stopped making any new energy investments in July, August of last year. And that theme had been in place, energy infrastructure, for about 4 years through the beginning of the boom in energy production. Our view is that at that point, market went through a gear change where money started coming from the companies that benefited directly from the growth in volume, like producers and service companies and infrastructure, to the companies that would benefit from a stronger consumer and low energy prices. So the market really went through a gear change. Consumer took over, technology took over, transports took over. And so really we have a very small weight remaining in that group. On the other side, we are focused on things like the refiners that benefit from low energy prices and consumer.
Dorothy is next up, who's in Toronto. Good afternoon.
Hi, good afternoon, and thanks for taking the call.
You're welcome.
David, I'm wondering in the technology realm if you're seeing organizations and, in fact, governments needing to spend more on security. And if you like that trend or that aspect of the technology space, what do you think about Palo Alto Networks?
Great.
Thank you.
So Dorothy, this is a very important theme in the market. So there's a couple of themes that are big, have big tailwinds right now. Certainly the Internet of Things, which is more connected devices to the internet, means it's a great thing for semiconductor companies and for software companies. The big issue that a lot of companies have is security right now, and there is a bull market in security risk. So companies that can help to mitigate that are doing really well. Somebody said there are something like 70 serious security breaches a day today in big corporations. Palo Alto, to us, appears to be the winner in this space right now. There's a number of companies doing well. We own Palo Alto. Their most recent quarter, they had 55% revenue growth. They beat the estimate by about 12%. And this is a company just seeing consistent increases in the estimates coming from analysts. So it's expensive, but I would argue probably the analysts are being too conservative with their estimates of earnings and revenue growth. Revenue is growing at close to 100%. This is one that we own. You just have to understand, it's in the tech space, a little bit more volatile. But I would buy the stock today.
What's the estimated price earnings ratio? Do you know?
Oh, it's like 170 times
Okay.
based on estimates. But just remember that very often companies that are growing rapidly are cheaper than people think because the estimates are maybe too low. Mm-hmm. And what we are seeing is fairly steady ratcheting higher. If you look at, for instance, the financial services industries, there's estimated to be as much as $100 billion of spending that's going to be required to bring their networks and their security up to par. So there's a lot of money going to be spent in this space, and Palo Alto is right in the middle of it.
All right, and a great looking chart as we saw there. We will take a break here with David and get back to your questions after this.